94.3.
This is Good Morning Mumbai with Hrishi K.
Radio 1.
At least once a year, I have the privilege of talking to this gentleman, and it's always so pleasant. Also, because there are lots of learnings from me and takeaways for me. Welcoming Mr. D.B. Singh, Deputy Managing Director and Joint CEO at SBI Mutual Fund, a gentleman who has over 3 decades of rich experience in the banking and financial services industry. Today, as Deputy MD and Joint CEO, he's responsible for supervising all business verticals and segments of the organization. But over the last 2 decades, if we look at his career, many senior leadership roles that have led the company's consistent growth in several parameters. If you look at assets under management, market share, profits, they're really instrumental in expanding SBI Mutual Fund's reach in both urban and rural areas. How are you, sir? So nice to see you.
Thank you, Rishi. Very fine. Absolutely fine.
Now, I want to look at the last 5 years or so. What are the changing investment trends and changes in investment behavior that you have seen happening personally?
Thank you, Rishi, for having me on the show. And responding to your question, the best thing which has happened in the country during the last 5 years in the area of investment is that the youngsters, the young people, are adopting investments in a big way. They are no more into the spending spree, they are into investing spree. And you look at any group of youngsters today, they are talking about investments, they are talking about stocks, they are talking about mutual funds, rather than talking about the car models or the bike models that's they do in their private, but in general. So that's the biggest, and the responsible behavior of youth towards investment has changed a lot.
Yeah, as far as millennials and Gen Z are concerned, there's no doubt about that. Also, regular advocacy measures, what SBI Mutual Fund does in the media, conversations like this really help, sir. I want to ask you now about mutual fund penetration, because for that, you need even slightly older people. Baby boomers, some millennials who haven't converted as yet, people who come and ask you why they should not keep their investments in traditional avenues, real estate, gold, FDs. What is your answer? And therein linked to the question is, has mutual fund penetration increased in the last decade, and if so, then by how much?
The first thing is, Rishi, the information arbitrage which was there in the investment arena, that the people sitting in Bombay and Delhi or Bangalore are having much more exposure to the investment avenues than the people who are sitting in tier 2 towns or the smaller towns. That is no more there. Now, a CFO or the top company of India has the same information as a colleague of mine working in a branch of State Bank of India at a hilly spot where it is closed for 6 months. He is also having the same information what a CFO has. So both can work on the same information. That is one big thing which has happened with the connectivity all across the country. The digital tools which are available, do it yourself. Anybody clicking from Mumbai or clicking from Lahore Spiti at the same speed when it will be done. That is the one big thing has happened. And second, you said yes, the older people, even people who are above 60, once they get their retirement benefits also, they are no more interested in traditional avenues of FDs. They are not in traditional avenues of putting in RBI bonds. They are also looking for solutions in mutual funds and investment arena. And there's enough number of products which are available in mutual funds to take care of all their needs, and every individual needs can be knitted around with the products of mutual funds. Another thing, and that information dissemination has happened in a big way all across the country. And the behavior of the investors, that they don't panic when the markets go down, they don't come into greed when markets go up. They are, in general, are behaving in a very mature manner. That's a big thing which has happened, and more people are getting into the mutual fund arena. But yes, the penetration is low at the middle of the pyramid and the bottom of the pyramid. Actually, the people who are having enough surplus money, people who are having the big money tickets of say 5-10 lakhs and above, they are being serviced properly, but the lower ticket businesses are not being serviced by the intermediaries because of the economic viability of remuneration concerns. But I think that will also be taken place. Regulator is working very proactively to make sure that the penetrations go up, and they're coming out with the regulations. They will come out with the regulations for sure, which creates much more ease of business, doing business in the investment arena.
Still to come, a detailed deep dive into equity culture with my guest of the day, DP Singh, Deputy Managing Director and Joint CEO, SBI Mutual Fund. Stick with us on 94.3 Radio 1. I'm Hrishi K. They have a brand new fund offering in the energy space, so we're going to talk about it in some time. But the beauty of having Mr. DP Singh in studio is that the conversation can diversify, and we can also get his advice on investing in the short as well as the long run. The Deputy Managing Director and Joint CEO of SBI Mutual Fund is my guest of the day today.
94.3
This is Good Morning Mumbai with Reishi K.
Radio 1.
Mr. Singh, I want to talk about equity culture. What advice would you give to both investors as well as distributors on having a long-term investment mindset? I mean, you see, again, a lot of young people being aggressive with equity, taking lots of equity, maybe a little bit of debt. At the other end of the spectrum, again, slightly older people feeling, am I risking it too much as far as equities is concerned?
Yeah. See, equities are a long-term play. One golden rule is if you are investing in equities, your investment horizon should be minimum 3 to 5 years. That is the minimum. And more the merrier. You keep it for 8 or 10 years, you will get the benefit of compounding. The only behavioral part which I feel the investors in general and Gen Z and millennials in particular have to take care that they keep it for long term. What has happened during the last 5-7 years that market is seeing one side of the forget about the dip which happened in 2020. Overall the graph is on the higher side, so anybody who has put in money is making money. So what they are using investments in equities just like a savings bank account. They put in money, they withdraw after 3 months, they withdraw after 6 months. They register SIP, but SIP whatever is accumulated, they withdraw money from that kitty which has been accumulated. So that is something which we need to take care of, and we have to see that when we are putting in equities, we keep it for long term. But without equity, we cannot generate inflation beating returns. The traditional interest bearing securities or the traditional FDs or the bonds will give us a percentage which is not tax efficient. Even our government is rewarding the risk which people take in the equities. That's why they are offering a preferred tax rate for the equities. And there's another category which is called the multi-asset category or hybrid funds, where you can get the benefit of indexation if you keep your money for more than 3 years, where 35% equity is there. So the idea is that you don't only take care of the returns on the investment but have to take care of the tax outgo also. That is also a very, very important issue. So these two issues put together, I think equity has to be there. What percentage as per the risk appetite, whether you want to be 25%, 20% or 100% of the surplus money, it depends upon individual's risk appetite and individual's comfort over the period of time. If you ask me at my stage also, today 100% of my surplus is in equities because sustenance money is already taken care of. So it depends upon the stage of life where you are, what kind of money you are having. If you are keeping your surplus for the sustenance purposes, then definitely you cannot put 100% in equities. You have to have a mixture of debt and equity, but in such a manner that you get the benefit of tax efficiency, the preferred tax rates which are offered by the government. That's extremely important.
Up ahead, all the deets on SBI Mutual Fund's new fund offering, the SBI Energy Opportunities Fund, courtesy Mr. DP Singh, Deputy Managing Director and Joint CEO, SBI Mutual Fund. Keep it tuned to 94.3 Radio 1. My name is Reishi K. The energy sector is booming, and just an opportune time for SBI Mutual Fund to launch the SBI Energy Opportunities Fund. Mr. DP Singh is my guest of the day today. He's Deputy Managing Director and Joint CEO, SBI Mutual Fund. And before we sign off, time to talk green energy for a bit.
94.3
This is Good Morning Mumbai with Reishi K.
Radio 1.
Now, it's very interesting because the fund shall invest in oil value chain, gas value chain, power value chain, green energy, which there's so much being said about solar values, wind power, hydrogen value chain. Of course, batteries, EVs are also the buzzword these days. Gas value chain, which is gas transmission, city gas distribution, power value chain, And these are the kind of schemes that they're going to invest in. And I imagine there's going to be a regular as well as a direct plan and the growth option as well as the
No,
income
that's
distribution.
yeah,
Standard.
that's per the regulatory
By the regulatory.
standpoint that is there. Both regular people can come direct, people come through distributors. Actually, intermediaries play a very very important role. Honestly speaking, hand holding of the investor by the when anybody who feels that he is well aware of the concept, well aware of everything, they can jolly well come direct. But I will personally suggest that an intermediary, because yes, there's a cost difference, but at the same time, the value which is created by an intermediary is huge.
That's valuable advice there. Also, if you want more information, there's lots of detailing on the fund manager, and the minimum investment amount is of course 5,000 rupees, multiples of 1 rupee thereafter, and then you can add additional purchase amounts of 1,000. This is at sbimf.com. So please go to sbimf.com for more details. A wonderful offer, and just a few more days left. 3 days and some. The 20th Feb is the NFO close date. Thank you very, very much for your time, and all the best.
Thank you, Rishi.
For SBI's
Thank
Energy
you.
Opportunities Fund, and I hope to speak to you soon. Regards.
Thank you. All the best, and always a pleasure speaking to you. Great.
That was Deputy Managing Director and Joint CEO SBI Mutual Fund, Mr. DP Singh. Stay with us on 94.3 Radio 1. My name is Hrishi K.